Hi, my name is Pieris Markou, and I would like to welcome you to our first of a new series of quarterly tax updates brought to you by the Deloitte Cyprus Tax team. The main aim of these quarterly tax updates is to give you some high-level insights to major tax developments in Cyprus and brief updates of developments around the world that may have an impact on companies operating from Cyprus. In today's webcast covering the period from January to March 2015, we will briefly look at some local tax developments, provide you an update on tax treaty developments, and briefly cover some international tax events. As far as the local tax developments are concerned, we need to remind you of the extension to the self-assessment obligation, which is now extended to all taxpayers. Previously, you will recall, only companies and self-employed individuals had the obligation to calculate and pay their balance of tax due via self-assessment. From this year, and affecting tax year 2014, the self-assessment obligation is extended to all taxpayers. Salaried and other individuals that have an obligation to submit a personal income tax return should calculate and pay any remaining income tax due to the tax department within 2 months from the submission deadline date of the Form IR1. In this respect, as the manual submission deadline of the IR1 form for salaried individuals is 30th of April 2015, the deadline for paying any remaining income tax due via self-assessment is the 30th of June 2015. We have developments from the Cyprus Tax Department and their new initiative. During the first quarter of 2015, the Tax Department commenced site visits to 266 companies that it has categorized as large taxpayers. The Tax Department has dedicated a team of 20 tax inspectors who are currently going through the process of documenting the business activities of these companies with the aim of understanding the respective tax risks involved and the impact such activities may have on public revenues. Furthermore, the Integrated Tax Department is currently in the process of providing a single registration number to each taxpayer. The adoption of the single registration number is expected to result in time efficiencies and better service to the taxpayers. As far as immovable property tax is concerned, in order for the property developer to transfer the property tax obligation to the purchaser, the property that has been delivered to the purchaser but for which the title deed has yet to be issued, the property developer would need to complete and submit the Form TF317. The submission deadline for the Form TF317 has been extended from 31 of March this year to 30th of April 2015. The form can be submitted online and a separate form should be submitted for each property development. It is also noted that the property developer should send the Form 318 fully completed to the purchaser in order to inform them of the values on which their tax liability will be based on. Finally, there has been a change in the public interest rate, which has now decreased from 4.5% to 4%. So any refunds of tax or any delay in payment of tax will be subject to this new rate of 4%. A number of new tax treaties were signed last year. Let's have a look at the new tax treaties that have come into effect from 1 January 2015 and one new tax treaty signed during this quarter. Let's have a look at the tax treaties which have come into effect from 1 January 2015. From 1 January 2015, 4 new tax treaties for the avoidance of double taxation between Cyprus and the following countries have come into effect: with Spain, Norway, Lithuania, and Iceland. The tax treaties with the above-mentioned countries are based on the OECD Model Convention, providing for the avoidance of double taxation on income and on capital, as well as for the exchange of information between the contracting states. Here are the applicable withholding tax rates for these treaties. The tax treaty with Spain provides for nil withholding tax on dividends if the beneficial owner is a company holding at least 10% of the capital of the dividend-paying company and 5% in all other cases. Interest has a zero withholding tax and royalties, again, zero withholding tax. The tax treaty with Norway provides for zero withholding tax on dividends if the beneficial owner is a company holding at least 10% of the capital of the dividend-paying company and 15% in all other cases. Interest and royalties are subject to zero withholding tax. The treaty with Lithuania provides for zero withholding tax on dividends if the beneficial owner is a company holding at least 10% of the share capital or 5% in all other cases. Interest is subject to zero withholding tax and royalties to 5% withholding tax. The tax treaty with Iceland provides for 5% withholding tax on dividends if the beneficial owner is a company which holds at least 10% of the capital of the dividend-paying company and 10% in all other cases. Interest is subject to zero withholding tax and royalties are subject to 5% withholding tax. I will remind you that the full list of our tax treaties concluded by Cyprus can be found in our Tax Facts 2015, pages 27 to 31. One tax treaty has been signed during the first quarter of 2015. This is a treaty between Cyprus and Bahrain, which hopefully would boost inbound investments into Cyprus. Below, we outline the applicable withholding rates on this new treaty. The treaty provides for zero withholding tax on dividends, interest, and royalties, and the provisions of the new tax treaty with Bahrain will come into effect on the first day of January following the date the two states exchange notification that all necessary procedures have been completed. For the international part of this quarter, I will concentrate on the Russian Deoffshorization rules, which have come into effect from 1 January 2015, and the ongoing developments with BEPS. Let's first look at the Russian Deoffshorization Law. In the latter part of 2014, within the framework of Russia's national strategy for counteracting tax abuse, a new law was voted introducing fundamental changes to the taxation of foreign entities. The new law provides for the concept of beneficial ownership, a new definition of corporate residence, a controlled foreign company regime, and new rules on the indirect disposal of shares of Russian real estate-rich companies. In addition, there are requirements that Russian legal entities and individuals should disclose information on their interests in foreign companies. The law is in effect from 1 January 2015. However, we understand that amendments are due to this law. For more details on the proposed changes, please refer to the tax alert of 24 of March issued by our Deloitte CIS office. Here is a summary of the major changes. Beneficial ownership. The new rules formalize the concept of beneficial ownership and give the Russian tax authorities a stronger basis for challenging issues relating to the beneficial owner of Russian source income. In particular, the law introduces the notion of a party having the actual right to income, according to which the direct income recipient in a number of cases may not qualify for the exemption from or application of reduced rates of withholding tax in Russia. Corporate residence. The new law amends the definition of tax residence for companies and is now based on the place of effective management of the company, not the place of incorporation, as it was under the previous law. The recognition of a foreign company as a Russian tax resident can result in being assessed to profits tax on its worldwide income in Russia and to comply with other rules prescribed by the Russian tax legislation. CFC rules. The law introduces rules which apply to the taxation of profits of CFCs controlled by Russian tax residents. CFCs' retained earnings may be taxed in Russia at the level of the controlling party at 13% if such party is deemed to be a Russian tax resident individual, or 20% in case of a Russian tax resident entity. A Russian tax resident may be deemed to be controlling if it directly or indirectly owns a certain share in a foreign company or exercises or has the possibility to exercise a dominant influence on decisions relating to the allocation of the profit of the foreign corporate or non-corporate entity. Indirect transfer of real estate property. The law provides for withholding tax at 20% with respect to income of foreign companies received from indirect sale of Russian real estate property. Previously, capital gains derived by non-residents were subject to Russian tax only if the non-resident sold shares in Russian real estate-rich companies. Finally, the new law imposes requirements on Russian legal entities and individuals to disclose information on their interests in foreign corporate and non-corporate entities and their control over such entities or structures. Specifically, direct and or indirect interest in foreign companies if the ownership interest is above 10%, establishment of non-corporate entities and control over such entities or actual right to receive income from such entities, and CFCs with respect to which a taxpayer is the controlling party. In addition, the law obliges foreign non-corporate entities that own real estate in Russia to submit information on their owners together with a property tax return on an annual basis. Indirect participation of an individual or a public company should be disclosed if the participation exceeds 5%. For further details on these changes, please refer to the tax alert of 27th of November 2014 prepared by Deloitte CIS. Now we will cover a quick update on the BEPS project run by the OECD. The growing perception that multinationals are not paying the fair share of taxes led to the G20 and the OECD initiative on base erosion and profit shifting, the so-called BEPS project, designed to develop approaches that will curtail international tax planning. The project, based on a 15-action plan, has brought together a total of 61 countries and has already resulted in global legal changes either by consensus or unilaterally or a mixture of both. For official documents and Deloitte comments relating to each of the 15 BEPS action points, please visit the BEPS Central, a one-stop shop for information on the project. For more on BEPS, you can subscribe to the World Tax Advisor, a bulletin of international tax developments which includes a BEPS corner in the first issue of each month, or visit the www.beps.tax website. During 2014, the first 7 deliverables were released in the latter part of last year. These were 3 reports which covered assessing the tax challenges of the digital economy, which was Action Plan 1, harmful tax practices, Action Point 5, and the feasibility of a multilateral instrument to implement the BEPS measures, which is covered by Action Point number 15. In addition, 4 instruments were issued tackling hybrid mismatches, tax treaty abuse measures, transfer pricing, and transfer pricing documentation, including country-by-country reporting. During the finance ministers and the central bank governors meeting on 9th and 10th of February 2015, it has been confirmed that the BEPS deliverables will be finalized by the end of 2015. An agreement has been reached on the implementation of the key deliverables of 2014 during this meeting. On Action 15, the development of the multilateral instrument to update a network of more than 3,000 tax treaties has been approved. The first meeting of the working group will take place on July 2015 with the aim of concluding by the end of 2016. Action point 13, the key elements of the implementation package have been agreed. Preparation and filing for the country-by-country reporting by multinationals with turnover above 700 million euros is expected to start in 2016, so that the first information is obtained by the tax authorities by 2017. Action point 5, a compromise solution has been reached regarding the substance requirements for patent box regimes. A nexus between the location of activities generating the income and jurisdiction offering the preferential regime is required for the regime to apply. During 2015, the deliverables are expected to be issued on Action 3, strengthening the rules on CFC, Action 4, limiting base erosion and interest deduction and other financial payments, Action 5, the second phase of work on countering harmful tax practices, Action 7, preventing artificial avoidance of permanent establishment status, Actions 8 to 10, which involve transfer pricing outcomes in line with value creation, Action 11, establishing methodologies to analyze BEPS data and the actions to be addressed, Action 12, requiring taxpayers to disclose aggressive tax planning arrangements, and finally, Action 14, making dispute resolutions more effective. During the first quarter of 2015, 10 discussion drafts have been issued for public comment and 6 public consultations were held. On February 12, the OECD also hosted its webcast to provide an update on the initiative, with the next webcast anticipated in April this year. To view BEPS webcasts as well as the project timeline, please visit BEPS Central or the BEPS Tax website. Finally, here are our contacts for the Cyprus Tax team in Nicosia, Limassol, and Larnaca. In addition, here is a list of our contacts for the Russian and CIS desk based in Cyprus, again both in Nicosia and in Limassol. For any comments on the Cyprus Tax webcasts, please email us on cyprustaxwebcasts@deloitte.com. This completes our first tax webcast. Hope to see you next time. Thank you for watching.